How the dot-com bubble burst. The 1990s was a period of rapid technological advancement in many areas. But it was the commercialization of the internet that led to the greatest expansion of capital growth the country ever saw. Although high-tech standard-bearers such as Intel, Cisco, and Oracle were driving organic growth in the technology sector, it was upstart dot-com companies that fueled the stock market surge that began in 1995. The bubble that formed over the next 5 years was fed by cheap money, easy capital, market overconfidence, and pure speculation. Venture capitalists anxious to find the next big score freely invested in any company with a .com after its name. Valuations were based on earnings and profits that would not occur for several years if the business model actually worked, and investors were all too willing to overlook traditional fundamentals. Companies that had yet to generate revenue, profits, and, in some cases, a finished product, went to market with IPOs that saw their stock prices triple and quadruple in one day, creating a feeding frenzy for investors. The Nasdaq index peaked on March 10, 2000 at 5,048, nearly double over the prior year. Several of the leading high-tech companies, such as Dell and Cisco, placed huge sell orders on their stocks when the market peaked, sparking panic selling among investors. Within a few weeks, the stock market lost 10% of its value. As investment capital began to dry up, so did the lifeblood of cash-strapped dot-com companies. Dot-com companies that reached market capitalizations in the hundreds of millions of dollars became worthless within a matter of months. By the end of 2001, a majority of publicly traded dot-com companies folded, and trillions of dollars of investment capital evaporated. How long did the dot-com bubble last? The dot-com bubble lasted about 2 years between 1998 and 2000. The time between 1995 and 1997 is considered to be the pre-bubble period when things started to heat up in the industry. Why did the dot-com bubble burst? The dot-com bubble burst when capital began to dry up. In the years preceding the bubble, record low interest rates, the adoption of the internet, and interest in technology companies allowed capital to flow freely, especially to startup companies that had no track record of success. Valuations rose and money eventually dried up. This led companies, many of which didn't even have a business plan or product, to collapse, causing the market to crash. What caused the dot-com crash? The dot-com crash was triggered by the rise and fall of technology stocks. The growth of the internet created a buzz among investors who were quick to pour money into startup companies. These companies were able to raise enough money to go public without a business plan, product, or track record of profits. These companies quickly ran through their cash, which caused them to go under. What caused the 2000 stock market crash? The 2000 stock market crash was a direct result of the bursting of the dot-com bubble. It popped when a majority of the technology startups that raised money and went public folded when capital went dry. The bottom line. When the internet took off in the 1990s, many startups launched to make use of the new technology. These companies had high valuations with little to no profits, riding the wave and hype of the new tech. A booming equity market funded them in the 1990s, which came with cheap capital. When the money dried up and these companies had no self-sustaining profits to continue operating, the crash finally came. For some companies, there was a brief period of price stabilization and increase, but these were short-lived. Most of these companies went bust.